let me continue with the discussion. And section 2 clause 19AA. I think all of you know what is a demerger. What is demerger, friends? What will happen in a demerger and how it differs from amalgamation? Before I look at this particular provision, just give a thought process to what is a demerger. See, in case of amalgamation, what will happen? One company goes into liquidation, the business of which will be taken over by the another company. So the transferor company will go into liquidation is something which we know. Now, in case of the demerger, what will happen? A company is there, it has got 2 or 3 undertakings. Out of the 2 or 3 undertakings, 1 or more undertakings will get transferred from that company to the another company. So, transferor company is named as a demerged company and a transferee company is named as a resulting company. Vendor company is said to be demerged company and purchasing company is named as resulting company. Even after the demerger, the transferor company, that is a vendor company, that is a demerged company, will continue to be there in existence only. Right? Now, demerger is happening, 2 or more undertakings of the demerged company are getting transferred to the vendor company, that is the resulting company, and the resulting company issues the shares to the, what is it, the demerged company. Then the transaction shall not be regarded as a transfer. But here also a problem is there. Let us suppose this resulting company and that demerged company are holding companies and subsidiary companies, subsidiary company, holding company. Then is it possible for the transferee to issue the shares? Not possible. Because if issues, again it has to take its own shares. So the requirement that purchase consideration need to be necessarily be issued by way of the shares is being dispensed of even in case of the demerger. Not only with respect to the amalgamation, even with respect to the demerger also. If the demerger is taking place between the holding company and the subsidiary company, then issuing of the shares requirement is being disposed of. So section 219AA, in case of a demerger, there is a requirement under section 219AA that the resulting company has to issue its shares to the shareholders of the demerged company on proportionate basis. However, it is not possible to satisfy this condition where the demerged company is a subsidiary of the resulting company. So keeping this in mind, now section 219AA has been amended so as to exclude the requirement of issue of shares where resulting company itself is a shareholder of the demerged company. So the requirement of issuing shares would still have to be met by resulting company in case of other shareholders of the demerged company. So the resulting company oblique amalgamated company cannot issue shares to itself, and hence it is a welcoming amendment. It's only a clarificatory kind of thing. I am not troubling you or asking you to write. Now I am moving to the next scenario, that is section 50D. Yes, you have listened in the regular class. Section 50 deals with what? Calculation of short-term capital gains arising on sale of depreciable assets. 50A deals with what? Transfer of depreciable assets by the power sector undertakings. 50B deals with what? Slump sale. 50C deals with what? Stamp duty valuation. Now I have got in the ABCD, now D is there. Pass at the earliest. Otherwise, today's Chidambaram's budget might have 50E also. Before it becomes a 50Z, pass your CA, right? See, some time back, one ranker is, somebody is taking the entry of a ranker. They asked the ranker, why you passed so early, right? Then the question itself is a silly question. So for such kind of the questions, you can't say that what is this question, the answer should also be silly, right? Now what the ranker told is, actually I also thought of taking some good time to clear the CA exam, because there is no greatness in passing the exam, there is a lot of greatness in doing the course, right? Really believe me, because till you pass the only tension is when you pass. After you pass, 100 tensions will come. What shall I do now? Right. So now the point of interest is the ranker said, I also want to take some good time and enjoy and then pass. But if I fail, every time I fail, I have to read 4 more accounting standards and 5 more standard on audit. So I thought better I pass at the earliest. So like that only, before this 50, section 50 has got 50 said, kindly pass. So now back to the point. Section 50D talks about what? See, in respect of assets for which cost of acquisition cannot be ascertained, there is no question of taxing when such assets gets transferred. Of course, this is now introduced, but I have certain stories about this kind of scenario. When we were studying, your 45 1A was introduced in those days. Insurance claim in case if you are getting for destruction or damage to the asset, then capital gains do arise. That is also again to revert some Supreme Court judgment. Similarly, goodwill is there. I am doing a business, there is a goodwill. Goodwill is of two types. One is a self-generated goodwill and another is a purchased goodwill. Purchased goodwill, I told that purchased goodwill is a royal name for the capital loss, and your accounting standard on fixed assets also says that goodwill is to be written off at the earliest, that is 5 years. Now self-generated goodwill is there. So the cost of acquisition cannot be ascertained. So I sold my goodwill to somebody and said, since the cost of acquisition cannot be ascertained, whatever the amount that I get is not to be taxed. Because for calculating the gain, I should know what is sale consideration, I should know what is cost of acquisition. So since self-generated goodwill arising from business, since cost of acquisition cannot be acquired, I am not going to pay the tax, is what SC is told, and the case has gone to the Supreme Court level. Supreme Court also accepted. Later on, the finance minister brought an amendment stating that in respect of the self-generated goodwill arising out of the business, the cost of acquisition shall be taken as nil. Once the cost of acquisition is taken as nil, happy well, whatever the consideration that you are getting is to be totally be treated as what asset? Entire amount to be taxed as capital gains. Thanks to the lawmaker, still we are all being well protected. How come? Goodwill arising while carrying out the profession, cost of acquisition they have not decided. Thereby, if any professional makes sale of the goodwill arising out of his profession, it is not subjected to the capital gains. Now today, 50D says what? Full stop to all your dreams and dramas. Forever ever you take, if cost of acquisition cannot be ascertained, it is the fair market value. So the point here is fair market value of the asset will be the sale consideration if actual consideration is not ascertainable. Of course, 50D is not dealing with cost of acquisition. 50D is dealing with what is it? Sale consideration. If it cannot be ascertained, then the fair market value of the asset you take as the deemed sale consideration. In some situations, what will happen? It is not possible to ascertain the sale consideration because sale consideration is not clearly established. I give my watch, you give your gold chain. Exchange, it's a transfer. Now I am saying that since sale consideration for this is not expressed in monetary value, I am not going to pay the capital gains tax on transfer of my watch to her and taking a gold chain. Even if it is not spelled out, go to Chandana Brothers and find out the fair market value of the gold chain, and that you take it as a deemed sale consideration. So in a situation where the SSE says that it is not possible for us to ascertain the sale consideration, you are not being left. The law says take the fair market value of the asset which you are getting as a deemed sale consideration. So now take the point here. Fair market value, section 50D. Section 50D. Fair market value of the assets will be the sale consideration. Will be the sale consideration. If actual consideration is not attributable or determinable A question like this may come. Just look at, see each provision, wherever institute want to test that particular issue, in the amendments booklet they will give a example for that. That is also my observation in the previous exams also. So that student should not cry that, no, I don't know that a question like this can be framed. Right? So your amendments booklet says, Goodyear is an American company. First, read carefully. Half win is in proper reading. Goodyear is an American company. Singsel is a company incorporated in Singapore and is wholly owned subsidiary of the Goodyear. So Goodyear is an American company. You have two companies. One is American company, another is a company based in the Singapore. And this Singapore company is a 100% subsidiary. Wholly owned means 100% subsidiary of that American company. Goodyear is a promoter of an Indian company, GEL. So who is Goodyear? Goodyear is an American company and it is one of the promoters of an Indian company called as a GEL. GEL is listed in a, a stock exchange in India. Now Goodyear wants to make Singsel financially strong. So that American company want to make this subsidiary company in Singsel, which is there. Singsel where it is? Singapore. Singapore company को financially strong बनाने के लिए क्या करे उन्होंने? उसका जो shares है Indian company HEL में, उसको उन्होंने transfer कर दिए. किसको? Subsidiary को transfer कर दिए. So Goodyear wants to make Singsel financially strong and an important entity of the group. So Goodyear therefore enters into share contribution deed to contribute voluntarily the entire 74% of the shares it holds in the GEL to Singsel without any monetary consideration. Goodyear argues that no capital gains will arise since computation cannot be made since sale consideration is not ascertainable and is indeterminate. Now the Goodyear argues that charging section fails in this case. So you are given that fair market value of the shares of GEL on the date Goodyear contributed the shares under the share contribution deed is 500 crores and the cost of acquisition is 100 crores. So what is stated? How you have to invoke 50D. Now you have to make use of your knowledge in 50D in view of the section 50D introduced by the Finance Act of 2012. Sale consideration of the shares of the GEL in the hands of the Goodyear shall be taken as 500 crores and capital gain should be computed as what? Sale price 500 crores and cost of acquisition is 100 crores. The capital gain is 400 crores. Of course, we have not given effect to the indexation because years are not specifically stated in the problem. So, like such questions, there is always a possibility of appearing in the exam. Now friends, I am moving to the next section, section 54B. What is this section 54B? Try to understand the point like this. 54B is an exemption where if you have got an urban agricultural land, of course urban agricultural land, if it is compulsorily acquired, then gain shall get exempted. But I am not looking at an compulsory acquisition. In case if rural agricultural land anyhow is not a capital asset. So urban agricultural land, once it is being transferred and capital gains arises, earlier what is it? You can claim the exemption provided again you purchase another agricultural land, that what you are purchasing could be either a what is it, rural agricultural land or urban agricultural land. Now what we are saying is आप आपका अर्बन एग्रीकल्चर लैंड बेच के कंपनीज शुरू करो. क्या करो? कंपनीज शुरू करो. स्मॉल एंड मीडियम एंटरप्राइजेस एसएमई सेगमेंट में आ जाओ. आके कंपनीज खोल के उसमें 50% ऑफ द होल्डिंग आप एक्वायर कर लो. फॉर एक्वायरिंग दैट 50% होल्डिंग इन दैट पर्टिकुलर एसएमई, whatever the investment that you are making, that investment will be eligible to claim the exemption under section 54 GB is the point. So now the point here is you have to understand that the move is always towards what? Wherever the government wants some investment to come, it encourages the people to make sale of other assets and invest in those sectors, so that capital gains we will give the exemption. Your 54 GB is also a move in that direction only. So 54 GB, before this amendment, the benefit of exemption from capital gains on sale of agricultural land is available to the SSE on reinvestment of the capital gains for purchase of another new agricultural land within 2 years. This is known to all of us. Now, one condition is that land should have been used by the SC or his parent for agricultural purpose. Now this provision is amended with effect from assessment year 2013 and 14. Of course, this is something what we say, sorry, slightly I am making this thing, it is not with respect to the agricultural land I am saying. You make sale of your residential property and invest in the small and medium enterprises. With respect to the what is it, agricultural land, the amendment is with respect to what? Amendment is with respect to earlier the land must be used by the SSE or his parents. Now they have also included your what is it, this one, which one, HUF also. What 54 GB I am saying is with respect to if you have a residential property, usko बेच के एक small and medium enterprises लगा दीजिए. So please write down 54B. First we will finish off 54B, then we come to the 54 GB. 54B, if an SSE makes a sale of, if an SSE makes a sale of urban agricultural land and reinvest the capital gains and reinvest the capital gains in purchase of another new agricultural land within 2 years then such capital gains gets exempted. However, agricultural land sold must be used either by him or by the parents for at least 2 years. Just before the date of transfer for agricultural purpose. Now the amendment brought in the law is even if such land is used in the used by the HUF where the SSE is a member, it is a sufficient compliance. It's a sufficient compliance. Now friends, 54 GB, yes, it is not the agricultural land, it is the residential property, residential house or a plot. If a residential house or a plot is being transferred by an individual or HUF, and as a consequence to that he gets some capital gains, he can claim that particular capital gain exempted by investing in the shares of a new small and medium enterprise company. Of course, that small and medium enterprise company should make use of this particular money for what purpose? For purchase of new plant and machinery. Of course, there are certain conditions to be complied with. So here try to understand who are the SSEs to whom this 54 GB is applicable: individual and HUF. What is the capital asset that must be transferred? It must be a residential house or a plot. Then by investing, where they can claim the exemption? By investing in the shares of small and medium enterprise company. And that small and medium enterprise company should use this money for what purpose? For acquiring the plant and machinery. Apart from that, what are the other conditions that are being kept there? Investment company should qualify as a small and medium enterprise under the Small and Medium Enterprises Act. Company should engage in business of manufacturing of any article or thing, and then small and medium enterprise should be incorporated within a period from 1st April of the year in which the capital gain arises, and the SSE, and before the due date for filing the return by the SSE under section 139(1). So that means we are encouraging you to make investment in a newly started small and medium enterprises. That small and medium enterprise should have been started on in between what date? first day of the financial year in which that asset is getting transferred. And what is the date? Other date before the due date for filing the return by the SSE under section 139(1). Now the SSE should hold more than 50% of the share capital or voting rights after the subscription in the shares of the small and medium enterprise. So he must be the big holder. He must have controlling interest in it. 50% of the shareholding, that is, shares carrying 50% of the voting power, this particular gentleman should hold. Then the SC will not be able to transfer the above shares for a period of 5 years. Lock-in period is also being kept. That is, a बच्चों का खेल नहीं, आज सेल कर दिए, कल इन्वेस्ट कर दिए, परसों बेच कर दिए सेल्स शेयर्स, ऐसा नहीं करना. कब तक है? लॉक इन पीरियड ऑफ 5 years is there. You have to retain that investment there. Company will have to utilize the amount invested by the SC for purchase of what? उन्होंने भी किसके लिए? बिल्डिंग्स वो सब खरीदने के लिए नहीं, एयर कंडीशनर्स खरीदने के लिए नहीं, प्लांट एंड मशीनरी खरीदना, plant, new plant and machinery. If the entire amount is not so invested before the due date of filing the return of income by the SSE under section 139, then company will have to deposit the amount in the scheme to be notified by the central government. आखिर ए स्मॉल एंड मीडियम एंटरप्राइज कंपनी किसका है? वो जो एसएससी वो एसेट्स ट्रांसफर कर रहे हैं ना, उनका कंपनी है. ए वी आर एनकरेजिंग यू टू मेक सेल ऑफ योर रेसिडेंशियल हाउस और द प्लॉट, और एक कंपनी खोलो, वो भी कैसा कंपनी? स्मॉल एंड मीडियम एंटरप्राइज कंपनी. उसमें तुम्हारा शेयर्स कितना है? 50% होना, और यू मस्ट मेक यूज ऑफ दिस मनी फॉर व्हाट पर्पस? फॉर परचेजिंग प्लांट एंड मशीनरी. And such a purchase of plant and machinery should not be sold, should be done before what date? Before the due date for filing the return. And if you can't do that, then invest in a particular scheme. Capital gains deposit scheme के जैसे एक scheme central government will notify, in that you deposit, that company has to deposit. And similarly, that plant and machinery जो खरीद लिए small and medium enterprise, it should also not be transferred for 5 years. How many conditions government will keep to give the exemption, right? After looking at all these conditions, no fool will like to have this particular exemption. Now Vaishnavi is smiling. Then what for this particular section is brought, sir? If no fool also is interested to enjoy this particular 54 GB, finance minister knows that there is a course called a CA course, and there the students are tested for their memory also. So all these wonderful conditions, whether those future chartered accountants are going to remember properly or not, and their teacher Mr. Kalyan Chakravarti will make them to write or not, for that this kind of beautiful sections will come. See how many conditions. That is, I have to make sale of my plot of land or residential property. I have to start a company, small and medium enterprise company. I should become the 50% holder in it, and I have to that small and medium enterprise company should make use of this money for purchasing of the plant and machinery, and that also has to be over before due date for filing of the return by me. And if it is not done, it is to be deposited in a account notified by the government. Again, this plant and machinery which it purchased should not be transferred for 5 years. Again, I should also not transfer my shares which I got in the small and medium enterprise company for 5 years. If all these conditions are met with, then you can enjoy that 54 GB exemption, right? There is a question. What is it? Like, now the above conditions prescribed in the new section are very harsh. Of course, analysis part of it. Some resourceful person, it's a cry, you can see the cry. After a provision comes, how the crying can happen, right? Today budget is coming, evening a crying will happen. And across the country seminars and meetings will be there for the next 4 or 5 days. And even our Hyderabad chapter will be having some meetings either in FAPSI or in the gardens, public gardens. There we all go to assemble to see the provisions and crying. What is the crying here? See, criticism is a part and parcel of our life again. Try to understand, and we should be good critics also. As a chartered accountant always looks at what? Bad part. Of course, good part automatically there is no need to look at. See, whenever somebody brings a paper, first our eyes goes to the place where there is a mistake. Unless you get into that habit, you are not a chartered accountant. And if somebody talks to you, first chartered accountant thinks of what? What is the underlying motive in this talk? Chalo. Now, yahan kya bata rahe no? Some people unknowingly clapped for what the finance minister told. Now the chartered accountant started criticizing this. The above conditions prescribed in the new section are very harsh. The section should have allowed the investment in the existing SME company for the purpose of this exemption. Is the finance minister fool? He wants more people to come and start companies so that he can get more fees, ROC. So this gentleman is saying that why new SME, an existing SME में उन्होंने invest कर सकते ना? No, that condition is you start a new small and medium enterprise company. Further, investment in a LLP which satisfies the conditions of SME enterprise should also be permitted. You should have also permitted in LLP. Why I will permit? I want you to start a company so that I will get registration fees for the ROC through ROC. Right. The restricted time limit for acquiring a new plant and machinery will create difficulties, and therefore it should have been provided that SME company should have been allowed to make such investment in new plant and machinery within a period of 18 months from the date on which the SC makes the investment in the equity shares. तुम बोलते उन्हों कब सुनना? आपको इसका crying क्या है आपको मालूम हो रहा? When this fellow has invested the money in that SME, 18 months लगा लिए तो अच्छा होता ना बोल के बोल रहे हैं. But the government wants some kind of deposits to the banks. So why such a relaxation will be given by the government? The period of 5 years to retain the shares is too long. They should have made it 3 years. बोल के critic बता रहे. No. Every 5 years only elections will come. Right. So lock-in period is 5 years. For telling sessions, you can tell any suggestion. Okay. Now, I think I am keeping the time in this thing. I am not making it right. But please, as a sincere students of mine, please write that in our refer before exam notes, both in our refer before exam notes, we have to jottle down all the conditions to claim the exemption under section 54 GB. Now, there is a problem. Like this, the problems will come. See, that's the beauty part of the amendments booklet. They make the provision and explain the provision along with the problem, thereby making the life of the teacher very comfortable. If I need to frame this question, it will take so much of the time. To explain it, it will not take that much of time. Look at it. Mr. Akash sold his residential property on 2nd February 2013 for 90 lakhs and paid a brokerage of 1% on sale price. He had purchased the said property in May 2000 for 24 lakhs 36,000. In June 2013, he invested rupees 75 lakhs in the equity of A Private Limited, a newly incorporated SME manufacturing company which constituted 63% of the share capital of the said company. A Private Limited utilized the said sum for the following purpose. Purchase of new plant and machinery during July 2013, rupees 65 lakhs. You know, kitna invest kare? 75 lakhs. Now, I have to give you the, details for how that 75 lakhs is being utilized. 65 lakhs, happy well, they have invested in the new plant and machinery, and included in the A above 6 lakhs for the purchase of computers and 8 lakhs for purchase of cars. ये क्या बात है? Purchase of cars and purchase of computers are not, will they come under the plant and machinery? No. Air conditioners purchased for rupees 1 lakh. गर्मी है तो एयर कंडीशनर्स परचेस कर दिए उन्होंने, इंक्लूडेड इन द ए अबो. अच्छा, ये 65 lakhs में 6 lakhs वैसा, 8 lakhs ऐसा और 1 lakh एयर कंडीशनर. कार होना और क्या है, एयर कंडीशनर होना और कंप्यूटर होना. Then the amount is, balance amount is what? 75 minus 65 is equal to 10 lakhs. That 10 lakhs he has deposited in the prescribed bank deposit scheme. Compute the chargeable capital gain for assessment year 2013 and 14, assuming Mr. Akash is liable to file the return of income on or before 30th September 2013. He files his return on 29/9/2013. अच्छे बच्चे है. Next, look at the solution. Presentation part. Gross consideration is 90 lakhs. Less expenses on transfer 1% is 90,000. Net sale consideration is 89 lakhs 10,000. And index to cost of acquisition is 24 lakhs 36,000 into the index of the year of transfer is 852 divided by index of the year of acquisition 406. Now whether this 406 will be given in the problem, definitely it will be given, but 852 they are not going to give. So you please remember that 852 as the cost of inflation index of the current financial year. Now somehow I calculated what is the capital gain is 12,40,424. Now see, how to calculate the capital gains is a point. How to calculate the exemption part is what I have to calculate. Exemption, what they are saying is, what is the capital gain, friends? Capital gains is 37 lakhs 98,000. Exemption is 25 lakhs 57,576. How this exemption is being calculated? See, I think all of you are aware of section 54F. What is 54F? You make sale of you make transfer of any long-term capital asset, but invest in the residential property, then you can get 54F. There, you in all other sections, to the extent of capital gains, if you invest, that is enough. Whereas in 54F, what is it? That is, if entire net sale consideration is invested, entire capital gains gets exempted. If you are not investing entire, what is it, net sale consideration, only proportionately you will get the exemption. How to calculate that proportion? Capital gains into amount invested divided by net sale consideration. So even your 54 GB, which is a new section, has got a similarity to like section 54F only. So here 54 GB exemption, how I am calculating? My capital gains is 37 lakhs 98,000 into 60 lakhs divided by 89 lakhs 10,000. 89 lakhs 10,000 is what? Net sale consideration. Investment is what? 60 lakhs. How come 60 lakhs, sir? He has invested 75 lakhs na? Yes, he has invested 75 lakhs. 65 lakhs in plant and machinery and 10 lakhs in the deposit scheme. But out of that 65 lakhs, 15 lakhs is invested in assets which are not prescribed. Your air conditioner, computer, car are not the investments which we are prescribing. So how the working notes is being done with? Purchase cost of new plant and machinery is how much? 65 lakhs. And less cost of office appliance, that is computer, cost of vehicles, cars, and cost of air conditioners, how much? Total put together is 15 lakhs. 65 minus 15 is equal to 50 lakhs. And some 10 lakhs they have invested where? They have invested in the bank. So totally put together that becomes a 60 lakhs is a point. That is how the qualifying investment. Out of the total investment is not qualified. If that investment comprises of cars, computers, air conditioners, that and all you have to exclude as a point. Now friends, I move to the next section, section 55A. What is section 55A? Reference to the valuation officer. See, what is the present law and what is the amendment that is being brought? Under section 55, normally what is our present understanding without looking at the amendment? wherever the assessing officer feels that what the value the SSE is saying as fair market value, in case if the actual fair market value and the disclosed fair market value, if there is a difference of 25,000 rupees or if there is a difference of 15%, then a reference can be made to the valuation officer to value that particular property. See, normally what is it? There are some sections in the income tax law pertaining to the capital gains. 45(1)(a) deals with what? When insurance company, when your asset gets destroyed or demolished, gives another asset, then what is the fair market value of that particular asset you have to take, right? So when the value of the asset is forming the part of the deemed sale consideration, the SCs always try to put down the value so that their capital gains will come down, right? When it comes to the point of valuation of an asset and it is a part of the cost of acquisition, they always try to value the asset at a, what is it, higher value, so that what will happen, the capital gains will come down. What I am trying to tell, are you able to get the point? In respect of the assets which are acquired prior to 1/4/1981, what our law says, how to take the cost, either the actual cost or the fair market value as on 1/4/81. Now what the SSE will do, SC will go to a registered valuer and it takes the fair market value of that particular asset as on 1/4/81. Normally when he goes to a registered valuer, he influences that registered valuer and inflate that particular fair market value, right? As a result of that, capital gains will come down. But the present law, what we have is reference to the valuation officer is to be made only in a situations where sale consideration is deemed to be the fair market value and a wrong presentation of the fair market value is made. So as a result of that, the SSEs are still taking the benefit where fair market value of the asset happens to be the cost, there they are making the play. So the lawmaker want to put an end, not only when the fair market value of the asset becomes the sale consideration, even in a situations where fair market value of the asset you have to take it as a cost of acquisition, there also the assessing officer can refer the, what is it, matter to the valuation officer. Let us slowly understand what it is. Under section 55, where capital asset becomes the property of the SSE before 1st April 1981, SC can take the fair market value as on 1/4/81 as cost of acquisition. So under section 55A, where the assessing officer feels that the value of the asset as per the SSE is less than the fair market value, he may refer the valuation to the valuation officer. So as of now, only when what the fair market value the SSE says, if it is less than the actual fair market value, then only the reference can be made. So taking this into the mind, what the SSEs are doing in respect of the assets which are acquired prior to 1/4/81, they are taking the higher fair market values as the cost of acquisition, and the assessing officers cannot refer the matter to the valuation officers, because reference to the valuation officer is to be made only when fair market value is less than the, what is it, the cost of acquisition. If it is shown or the actual fair market value say come hoke fair market value dikha diye, to hi assessing officer can refer the matter to the valuation officer. But when cost of acquisition is the situation, which fool will show the cost as less than the fair market value. So to that extent they have analyzed the situation. Now the amendment is brought is under section 55A, where the assessing officer feels that value of the asset as per the SSE is more than the fair market value, he may refer the valuation of such capital asset to the valuation officer. So not only that, only when it is higher he has to refer the matter, even if it is lower also he has to refer the matter to the valuation officer. So here look at the court judgments and extract of the memorandum to the finance bill. Honorable Bombay High Court in case of CIT versus Daulat Mahata HUF, what it said, reference to the valuation officer can be made under section 55A only when the assessing officer is of the opinion that the value of the capital asset claimed by the SSE is less than its fair market value, and not when he has the opinion that fair market value of the property on 1st April 1981 as shown by the SC was more than the actual fair market value. To overcome a similar kind of judgments, this amendment is brought, and our finance minister then said, in such a cases, adoption of a higher value for the cost of the asset as a fair market value as on 1/4/81 would lead to lower amount of the capital gains being offered to the tax. So what is the analysis? Analysis is nothing but cry. Right. Prior to the amendment by the Finance Act of 2012, the assessing officer could refer the case to the valuation officer only when the value of the asset claimed by the SSE in the report of the registered valuer was less than the fair market value. Then why such kind of provision is made earlier? Because in all these sections, which sections? 45(1)(a) or 45(2). What is 45(2)? When capital asset gets converted into stock in trade. When capital asset gets converted into stock in trade, what is the capital gains? That is, your transfer definition says, what is it? When transfer includes conversion of capital asset into stock in trade, and your 45(2) says what? In such a case, year of chargeability is not the year in which the capital asset got converted into stock in trade, but the year of chargeability is the year in which the stock in trade is sold, and two incomes will arise. That is, one is the capital gains income and another is the business income. The difference between the actual sale consideration and the fair market value as on the date of conversion should be taken as a business income, and the difference between the fair market value as on the date of transfer conversion and the cost of acquisition should be considered as the capital gains. There the fair market value they will lower, right? So wherever fair market value becomes the deemed sale consideration, they will SCs try to lower the fair market value. So wherever they have done like that, assessing officer can refer the matter to the the valuation officer. That only that lawmaker thought. But later in some court judgment in respect of a property which is acquired prior to 1/4/81, they have claimed a higher fair market value, thereby resulting in higher cost, so that the capital gains will come down. There is no catch holding provision for such kind of drama. Now we have amended section 55A to that extent.